Most people believe the rules of banking are stable. They assume that once an account is opened, the relationship between them and their money stays the same. But the structure that governs access to money changes far more often than people realize. And in many cases, the rules have already shifted long before the public notices. Because inside the financial system, the rules are rarely announced when they change. They are simply implemented, quietly, gradually, and once those changes are fully embedded in the system, they begin shaping how money actually behaves. What appears stable on the surface often operates very differently underneath. Because modern banking is not built on static rules, it is built on evolving infrastructure. Infrastructure that constantly adapts to new regulations, new technologies, and new forms of financial risk. Over time, those adjustments slowly redefine the relationship between individuals and the financial system itself. This video examines how those changes happen, not through dramatic announcements or sudden events, but through gradual structural shifts that alter the way access to money works. Shifts that many people only recognize after the system has already moved on. To understand how rules change inside the financial system, it helps to begin with a simple observation. Banking systems are designed to evolve. Every financial crisis leaves behind new regulations. Every technological shift introduces new mechanisms for monitoring transactions. Every expansion of digital payments creates new layers of oversight inside the system. Each of these adjustments appears technical, administrative, often invisible to the public. But together they accumulate. Layer after layer of new rules embedded inside the infrastructure that moves money. Over time, the system that people interact with begins to operate under a completely different framework than the one that existed before. Yet most account holders never notice, because from the outside, their bank account still looks the same. The balance appears on a screen. Payments are processed. Deposits arrive. Everything seems familiar. But the system governing those transactions has quietly changed. One of the most significant shifts occurred as financial systems moved toward real-time monitoring of financial activity. Decades ago, banks processed transactions in batches. Payments were reviewed after they occurred. Suspicious activity was often detected days or weeks later. Today the system works very differently. Most financial activity is evaluated instantly. Transactions are screened in real time by automated systems, fraud detection algorithms, compliance monitoring tools, anti-money laundering databases, risk scoring models. Each payment passes through these systems before it is approved. The transaction does not simply move from one account to another. It is evaluated first. This shift fundamentally changed how financial access works. Because the system no longer observes financial activity after it happens. It evaluates transactions before they are allowed to proceed. That difference may seem subtle, but it represents a major structural change. In the past, the financial system reacted to problems. Today, it attempts to prevent them. Prevention requires authority. Authority to pause transactions. Authority to review activity. Authority to delay transfers until additional checks are completed. These authorities were introduced gradually, often through regulations designed to strengthen financial oversight. Each individual rule appeared reasonable, but collectively they expanded the ability of institutions to intervene in financial activity. The rules governing money became more conditional on verification, conditional on risk evaluation, conditional on compliance systems approving each step. None of this is typically explained to account holders. Because the system works smoothly most of the time. Payments clear. Transfers arrive. Accounts function normally. But behind the scenes, every transaction moves through a framework of rules that did not exist a generation ago. The transformation of financial infrastructure did not stop with regulatory oversight. Technology accelerated the shift even further. The rise of digital banking introduced new capabilities into the system. Banks gained the ability to monitor transactions instantly across global networks. Payment processors gained the ability to flag unusual behavior within milliseconds. Artificial intelligence systems began analyzing patterns across millions of accounts simultaneously. These technologies improved security. They reduced fraud. They allowed banks to detect suspicious activity far more effectively than before. But they also expanded the system's ability to control financial access. Because systems capable of monitoring transactions in real time can also restrict them in real time. The same infrastructure that protects financial networks also gives institutions, the ability to intervene quickly when they believe something requires attention. And once those capabilities exist, they rarely disappear. Instead, they become permanent features of the financial landscape. Most people remain unaware of how much the infrastructure has evolved, because the changes occur quietly. No announcement. No headline. No visible transition. The rules simply shift within the system. The interface remains the same. But the structure underneath becomes increasingly complex, increasingly monitored, increasingly controlled by institutional infrastructure. This gradual transformation creates a subtle disconnect between perception and reality. People continue to think of money as something they possess, something they can access whenever they choose. But in a digital financial system, access to money depends on networks that operate according to institutional rules. Those rules are not static. They evolve continuously. And once they change, the system begins operating under new assumptions. Assumptions that the public may not yet recognize. For example, many people still assume that once a transaction is initiated, it will proceed automatically unless something goes wrong. But modern payment infrastructure does not work that way. Transactions must be approved, not only by the sending bank, but also by networks that route payments, by fraud detection systems, by compliance databases screening financial flows. Each layer applies its own rules. Rules designed to detect patterns associated with risk. The transaction moves forward only if it passes through every stage successfully. In most cases, the process happens instantly, invisible to the person initiating the payment. But the approval process exists nonetheless. And the rules governing that process continue to evolve. New regulatory requirements appear. New compliance thresholds are introduced. New monitoring technologies are implemented. Each adjustment changes how the system evaluates financial activity, yet those changes rarely reach public awareness. The system simply begins operating under updated conditions. Over time, these incremental adjustments accumulate, until the financial system begins functioning under rules that are very different from those people assume still exist. This phenomenon is not unique to banking. Large institutional systems often evolve quietly. Legal frameworks change through regulatory updates. Technology introduces new capabilities. Organizations adjust procedures internally. But because the external experience remains familiar, the deeper changes go largely unnoticed. Until one day the difference becomes visible, often in a moment that feels unexpected. A transaction that is suddenly declined. A transfer that requires additional verification. An account that undergoes review before activity can continue. These moments can feel surprising. But they are rarely random. They are usually the result of rules that were introduced long before the incident occurred. Rules embedded inside systems that operate continuously behind the scenes. Once those rules exist, they shape the system's behavior. Not occasionally, but constantly. The account holder may not see them, but the system follows them every time money moves. If you want to understand how these hidden financial mechanisms work before they affect you, consider subscribing. Because most people only begin noticing them after the system has already applied them. The quiet evolution of financial rules also reflects a deeper shift in how money itself is structured. Historically, money often existed outside institutional systems. Physical currency could circulate independently. Ownership was simple. If you possessed the cash, you controlled it. Digital finance gradually transformed that model. Today, most money exists inside institutional infrastructure, bank accounts, payment networks, digital transaction systems. These systems provide enormous convenience. They allow instant payments across continents. They support global commerce. They connect individuals to the broader financial world. But they also introduce something that physical money never required: permission. Digital money moves only when the system authorizes it. Authorization depends on rules. Rules defined by institutions responsible for maintaining financial stability and regulatory compliance. Those institutions operate under legal obligations. They must monitor financial activity. They must detect potential risks. They must intervene when systems identify patterns that require investigation. These responsibilities shape the architecture of modern finance. Architecture that constantly adapts to new risks, new technologies, new regulatory frameworks. Each adjustment modifies the rules governing financial activity. But those rules rarely appear as dramatic changes. Instead, they appear as updates, new verification steps, new transaction thresholds. New monitoring procedures. Each change seems small, but together they redefine the system, gradually shifting the balance of control inside financial infrastructure. Not through dramatic policy announcements, but through quiet structural evolution. And once those changes become embedded, they rarely reverse. They become part of the permanent operating environment of the financial system. This is why the rules often feel as if they change suddenly. In reality, they change slowly, over years, sometimes decades. But the public only notices when the difference becomes visible in everyday experience. When the system behaves differently than expected. When access to money depends on rules that most people never realized had already been rewritten. At that moment, the realization often feels unsettling. Because the system did not suddenly change. It simply revealed the structure that had been evolving quietly all along. Have you ever experienced a moment where a payment failed, a transfer was delayed, or your bank asked for verification you didn't expect?